Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I am thrilled that you're here. And I know you're going to enjoy the gentleman we're interviewing today. He's got great energy, and his name's Terry Painter, and he's the author of the Encyclopedia of Commercial Real Estate Advice, which I understand is an awesome book. And he's also the founder of the Apartment Loan Store, which ties right into what we do here on this show, which is buy apartments. So I want to welcome you to the show, my friend. Welcome.
Thank you. It's a pleasure to be here, Rod. Thanks.
No, you're absolutely. So maybe you could talk just a little bit about, how do I want to say this? Well, first of all, how'd you get into the business? Because you've got kind of an illustrious career. So why don't you take a minute and talk about that, and then we'll drill down on some of the nuances of what you're doing now. Yeah.
Sure. I actually, in 1995, 96, I had a chain of French bakeries and restaurants. And they were in shopping malls. But what happened, what I really loved about it was actually building a new one. I loved the development of it, training the staff and so on. What happened is that it was quite expensive. And my wife and my banker wanted me to slow down on opening up new restaurants. And so anyway, so my banker, who was also one of my best friends, I asked him one day, how can I do what you do? Because you work on a new deal every day. And I cannot, you want me to slow down in restaurants. My wife does too. So, he said, well, it's really going to be tough. You can't this takes at least 2 years, maybe 4 years to learn this business. So anyway, what I did is at the age of 43, I made a radical career change. And
wow.
Everybody thought I would fail except for my mom. But I was so excited about this. And, and I found and I just had to learn by doing deals. I mean, I was selling money, for God's sake. It was like, who doesn't want to buy money? But it takes a while to actually learn all the intense underwriting guidelines. I was doing business loans and commercial real estate loans out of the gate. And so, but what I found is that I actually just loved working on deals. And I have closed hundreds of loans. I can't wait for the weekends to be over so I could go back to work to this day. Actually kind of stressful for my third wife now, but I have learned to spend time with my family more. That was a hard lesson. It's important.
Well, yes, I got that memo myself. My greatest regret in life was coming home to our $10 million mansion on the beach and playing with my kids, but being focused on real estate so much that I was distracted when I was with them. To this day is my greatest regret. So no, I love it, buddy. And it's awesome that you love what you do, and it comes out in your energy and just so you know, I'm sure you know that, but I'm sure you've heard that, but so let's talk about, let's start with, I know that you speak to large real estate brokerages like KW, and you educate the brokers. Can you talk about some of the stuff that's coming up right now? Because we started to talk about before I hit the record button, and I think it's really relevant for the people listening. So if you would speak to the market.
One phenomenon that's happening today that I have not seen in the last 24 years of working in this field is buyers actually wanting to close on a property, and they have to exercise the financing contingency, which kills the deal because they actually applied for the wrong loan. And because it's so competitive out there, you're not going to get a second chance to start all over, because it's going to take probably 45 days with another lender, and there's already backup offers on that property. So it is, so it's really, if there was ever a time to make sure that you pre-qualify for the financing for a commercial property, it's right now. And where a residential property has 2 pre-approvals, a commercial loan has 7. And that is like a lot. And all it takes is one of those. Let's just say that the location, doesn't make it, or everybody's on month-to-month leases, and the lender, and for that program you apply for, they don't like that if it's an agency loan.
Or too many residents from the same employer, even is it?
Sure, exactly. Or too many military, too many students.
Right.
And so it's really what you really want to do is work. It's really important to work with a really sharp commercial mortgage broker, or even your bank, it's okay to go through a bank, but you want to make sure that you ask the bank what their qualifications are on those 7 pre-approvals, because banks have those too. So, and those are all in my book. Yeah.
No, nice. Well, I will tell you that a good loan broker, and I believe in especially in people when they're brand new at the very least, and even beyond then, to work with a loan broker, because if you're dealing directly with the lender and you don't position yourself properly, you don't present the deal properly, the loan package isn't properly created and put together, you're going to lose the loan. Where if you've got a loan broker, they can clean all that up and present you in the best possible light. I mean, not obviously nefariously, but accurately, but certainly position you for approval rather than
exactly.
decline.
Oh yeah,
right.
I totally agree with you. Because also a skilled commercial loan broker is going to know all the underwriting guidelines for all their programs, and they're going to take a look at those 7 pre-qualifications and make sure you fit for the program. Because otherwise, what could happen is you could actually get a letter of interest. You think the lender has looked at everything. Well, what we do at our firm is we make sure that we run the whole deal by the credit manager or whoever's going to be signing off on approving the loan as well. And and we could tell you I could tell you that you need to do that as well. Make sure that the loan officer actually does run it, up the flagpole.
That brings me to a question. At what point should someone involve you? I mean, I know the answer, but I'd like you to say it in a deal that they're considering. At what point should they bring you in to evaluate what's available for that deal? I mean, I think I just answered the question.
Yeah. Well, here's the thing. That's what's really good about working with mortgage brokers that are skilled in commercial real estate, is that they will give you the time to actually help you evaluate deals. They'll have great connections with real estate brokers that could help pull, and appraisers can help ballpark market rents and so on. All these facts that you're going to need to know, and they could probably it's really difficult with just the offering memorandum these days. Well, we should talk about that, Rod.
Right. Okay.
And these properties. Yeah,
let's talk about the OM. Okay.
Yeah,
so guys, when you get, obviously for those of you brand new, when you get a package from a broker, you're going to get an offering memorandum. Okay. And that's going to be, and it's kind of a misnomer in that when you present it to investors, it's also could be an offering memorandum, but yeah, let's talk. We're talking about the broker offer memorandum.
Exactly.
Right.
Because because there's such a shortage of properties on the market, such low inventory right now. What's happening is that most of the deals that our clients are bringing these days, if they're just desperate to find properties, they're not sold on actual. They're sold on potential. Now think about it. If you were buying a business, let's say let's just say it's a tire store that was being sold on pro forma. Well, we want $250,000 for this business. It's not, and because it's not making the $90,000 a year that we're stating now. It's only making 25. But in a year or so, when you build the business up, you're going to get it up to $90,000, and we still want $250,000 for it because it's a great business. Well, nobody's going to do that. So the problem is that now people are being pushed into doing exactly that. Yeah. What we're seeing in offering memorandums is, number one, is that they're not using market occupancy. Well, if they are sometimes they are using market occupancy, but what they're not doing is doing it the right way, where you have to take off 5% because that's what the appraiser is going to do. That's what your lender is going to do for vacancy. Sure. And they'll leave out like management. They leave out things, and they leave out just probably one of the greatest one is replacement reserves, and because appraisers and lenders do that. Sure. And the most, what I love is when I find.
No, before you move on, actually, let me hammer home a couple things you just said, because I'd like to clarify. Yes. So you talked, the lender requires 5% vacancy. The other thing you're not going to see on the pro forma is if it's a value add presentation, the higher vacancy year 1, 2, and 3, while you're doing that reposition. And that's a newbie mistake that I see all the time. Yeah. But So value add. And what was the second thing you just said? Because I wanted to hammer something home on that as well.
Replacement reserves.
Oh, the replacement reserves. Guys, when you borrow money from a lender, they're going to make you put money in a reserve account for a potential roof replacement, parking lot resurfacing, HVAC units, chillers, so on and so forth. And it can be significant. I can tell you on this Sedona deal we just closed in San Antonio, 296 doors. Ours is, I think it's 350, which is kind of high, but it's warranted in this case, and we're able to use it for interior finishes as well, which is kind of cool. So we'll be able to blow through it pretty quickly. But the point is, a lot of people don't realize they're going to have that requirement, and of course, that massively impacts your numbers. So
it really does. Yeah, it really does. Just like on a C quality property that needs some work. That doesn't have that many, it doesn't have like in the appraisal 40 years useful life left. It's going to actually, it could be $350 to $400 replacement reserves for a brand new property. The minimum is $150 per unit per year. So, but it's one of those things that also, when especially my newbie syndicators and those that are that are just buying commercial properties, multifamily for the first time, is that they really are looking at properties like it's just kind of like when you're dating. It's like they see all the best things first, and they leave out replacement reserves. They don't really. The other thing too, Rod, is quite often when somebody's selling a property, they lower repairs and maintenance. Mm-hmm. I see. That's the other one we catch. So what happens is that
no. Let's stop there. I'm sorry. Okay, I want to stop there because that is really important as well. Huge newbie mistake. Being and certainly there are sellers, unscrupulous sellers, and most of them aren't, but some of them are, that'll do all the repairs. Put all the costs or a lot of the costs associated with the property on maybe one of their other properties when they know they're going to sell one of them, because obviously anything that improves their net income is going to improve the value of the property. So that if they can leave some expenses off, they might do that. Yeah. But guys, what we teach at my boot camp, for example, is that you have to normalize the expenses. You've got to go through them line by line, and we'll give you ranges that you need to charge. And absolutely. Underestimating maintenance is one of the biggest newbie mistakes we see. Okay, because and it'll kill you. I mean, it'll bury a deal if you're too aggressive.
Yeah, I would say that. I can't tell you how many. Okay, so I've closed hundreds of multifamily and commercial real estate loans. And I can't tell you how many times, just as you're saying, Rod, that before the property, a seller knows they're going to sell the property quite a bit in advance, and what they will do is they'll pretty up some of these numbers. Mm-hmm. And I would say repairs and it's got like just a couple of weeks ago, there was a property in Dallas, and I said, do you realize that they're showing about $300 per unit per year for the C quality property for repairs and maintenance? I said, this property is probably about ready to fall down to the ground. It's probably in terrible shape if that's all they're spending.
And 4 times that would probably be more realistic. It's probably $1,200 a month would be more realistic on a C asset. Yeah.
So just as lenders, we, like all of our programs actually have minimums that they're going to apply anyway for underwriting for repairs and maintenance. But we quite a lot, what I want to do is I want to see like several years of financials to see if that's really all they've spent, or are they just trying to sell the property?
It's almost always BS. Guys, one of the things that one of the calculations that you do when you're looking at deals is called the expense ratio. And, it's just how much are the expenses versus the income. It doesn't include the debt, just but all property related expenses. And if you see less than 50%, it better be a newer property, candidly, in most cases. If you see less than 30%, it's BS in almost every case. So, just keep that in mind.
I'm afraid so. And that really gets back to for those clients of yours, Rod, that are just getting started, especially. It's like you could really be taken just like any other relationship. And what you want to do is you really want, like what we do is we turn over every stone, and we really are looking for the misrepresentations, and some of them are, a lot of them are not intentional, by the way. For instance, another one, Rod, since we're talking about expenses, is real estate taxes as one of our biggest problems. One of the first things I do.
Probably one of the biggest expenses you're going to have on an asset. You got to get it right.
Yeah, I go to the county okay, first of all, this is a situation where in almost all cases, the seller or the real estate broker, listing agent, is not trying to misrepresent the property, but on a large deal like the one you just closed, it could be a difference of $20,000 a year, maybe more, maybe
or more,
$50,000 a year, just because they applied the millage rate. They're using the millage rate that, which is actually how the county comes up, or the city comes up, and the city comes up with an assessment based upon their actual costs that they're passing on to property owners. But they could be using one. They're using the one that the seller had from some time ago, and it's not necessarily the current one. So, yeah. So quite often we find that real estate taxes are misrepresented, and so
and you could so that's a big one. Another one is insurance. You can underestimate the insurance. Like in Texas, been a lot of storms, and like on that San Antonio asset, we estimated what did we do? We did $450 a unit. And it ended up being $495 a unit. And by lucky, the property did so well, improved so well in the NOI while we were under contract, which is very unusual. That it offset that. So
that was fortunate. But I can remember Katrina. My God, in Florida, Louisiana, Texas, those Gulf states, properties were being sold with insurance quotes. I mean, just from the seller that were. Like at least, sometimes 1.5 to even a third, or at least 1.5 times less than what we would actually cost because of wind insurance.
Right.
And also you've got to keep in mind is that if you're talking about agency loans, Fannie Mae, Freddie Mac for your multifamily properties, they have fairly stringent insurance requirements, including business interruption insurance in case there's a fire or something.
Lots of add-ons.
And so you got to know really what your insurance. This insurance is another one. So in fact,
let me tell you what happened on this deal. So the current seller on this deal was only paying $250 a unit. And so we basically almost doubled it, and we should be good. Because they've had so many storms there in Texas, they've just gone through the roof. And so, we were still a little short. So even us with our level of experience, my partner's done $6 billion in acquisitions, can make, by the way, guys, not only do you need to involve someone like Terry in the deal early on, you should also involve a good third-party property management company, because they're going to know in that market what those expense line items should be, based on properties they manage there, and they're going to know what the labor cost should be, what the staffing at that complex should be. So you involve, these are the experts you bring in on your team to make sure that you don't make a big mistake, right? And so. This has been really good, Terry. So talk about, I don't know if we've finished up on the conversation around, this crazy market that we're in right now. And there are a lot of mistakes being made. Like I'll reference the San Antonio deal just because it's top of mind. Most of these deals, to get the returns right now that are going to attract investors, are doing, 80-20 splits, 70-30 splits. I've even seen a 90-10. We did our deal at 50-50 because it was such a really incredible deal, conservative, super conservative, and still have, great double-digit returns. And we'll be in the best and final on an offer, and we're just scratching our heads when we see what these things trade for. So I don't know, what these people are doing, if they're very, very liquid and doing lower loan to values, or, what are you seeing in the deals?
That's exactly what's happening is that, well, first of all, what's happening is that when we're talking about these overpriced properties, correct?
Right. Yes. That's exactly what I'm talking about.
Okay. Okay. So what's happening is that most of those are being purchased by 1031 exchange buyers who, what they've done is that this is old money, what we call old money, because they've made this from appreciation so many years ago that that what they can't do is buy a property that's overpriced. They're not as concerned as probably some of your clients are about putting in all these value adds, because in some cases they're looking for the depreciation to offset other incomes, or but if nothing else. But this was not money that's like some of your clients have worked hard for to invest.
It came out of Hip National Bank, right?
Exactly.
Not that money, right?
And so it works in that case, but And we are seeing people who are just like, the stock market just took a hit after just going nuts again for such a long, close to a year. And so there's a lot of what financial advisors are really recommending these days is also to diversify into real estate, even if it has as far as a ROI of or cash on cash return to begin with of 4% or something. Why? Because over time, just keep in mind that income real estate makes more money from appreciation than anything else.
Well, and with this current administration throwing trillions and trillions of dollars into this economy, what else do you think is going to happen? We're going to have inflation. It's already started. Yes. And inflation doesn't just impact the cost of goods, it impacts rents. Right. So, there's an advantage there too.
It certainly does. And what we see is when there's inflation, we do see certainly rents go up too, but also certainly go up, which is a good thing. But also what happens is mortgage rates have a tendency to go up as well.
Yeah, they can. We're locked like in our deal for 10 years. So we've got a little bit of a cushion, but that's if you're not, But
so these prices, they really do not make sense. I'm going to tell you a story, Rod, that's will really get this across. And this is why it still makes sense to invest in multifamily real estate at higher prices. In June of 2018, I have a client that's invested. We've done lending for over many, many years, and she found this. She was looking for a property in her neighborhood of Lincoln Park, Chicago, and she fell head over heels for this older property that needed quite a bit of work, but it was just a really great area, And so what she did, but I pleaded with her. I said, "Do not buy this property, please. Do not buy this property at a 5.5 cap, and then put $700,000 into these renovations. It just doesn't. The market rents don't support it." And you're not going to be able to make ends meet. And she told me, "You're just being so pessimistic. Please listen to me. My realtor says I could raise rents 20%, da, da, da." She did not want it. She knew she wanted what she wanted to hear it.
She wanted it. She let emotion get in.
Well, what I'm going to tell you. And I just told her, I said, "Well, I don't see how, I couldn't do a loan for her because the numbers didn't pencil, but she got a private loan. And I'm going to tell you that I was wrong from one standpoint. And that's that she's looking at another property. I talked to her a couple of months ago, and in this market now, that property has literally, the rents are over what she thought she was going to get, and cap rates on that property are, in the high fours now. Everything about that. So she's coming out really well, but it just did. From a lending standpoint, I couldn't see it, but.
Right. No, I get it. And it's really tough right now because, like there's I'm not going to mention a name, but there's a guy that's been on my show a couple of times. That's a very well-known investor, billions in assets, has his own jet and buys, A-class properties in the 200 to 300 per unit range. Okay. And I was like, what happens if the market shifts? Because that's a yield play. There's no value add. It's just hoping the rents go up. And I thought he was crazy. But now with inflation, he might be laughing all the way to the bank. I will tell you. What
we're also seeing at our firm is just that properties that are actually in really good neighborhoods, and this one in Lincoln Park, Chicago, certainly was, and that there's or anywhere where home, let's just say, just the value of a home is putting a lot of people out of the home buying market.
Sure.
But yet they have good upper middle class incomes. We're talking of over six figures. And what they can do is they actually, let's just say their rent, they're paying $1,400 a month. They could actually move up to 18, and so we're seeing that. So in better neighborhoods, it's amazing how much rents can move up. And that's what happened in this case.
Sure. No, we're not buying any C assets right now just because, who knows how long this COVID thing is going to be hanging around and the impact it has on so many different, the hospitality industry, the restaurant industry. And so we're not doing C right now because the one C asset we have, kind of got hammered, our Louisiana asset. And but all our other ones did just fine. We're in the 90s as far as occupancy. So
yeah, but it doesn't make sense. Why buy a C property at almost the same cap rate as a B?
Well, that
property?
too. Well, there is that too. Exactly.
Yeah,
So no, you're absolutely right.
It's something newer. Yeah.
Right. Well, unfortunately, I've really enjoyed this. I'm bumping up against a hard stop here, but I've really enjoyed this conversation with you. And guys, the name of his company again is the Apartment Loan Store. He's the author of the Encyclopedia of Commercial Real Estate Advice. And I've really enjoyed this time with you, buddy. And I'm hoping that we continue this relationship. Yeah. So appreciate you coming on.
Okay, it's been fun, Rod. Thanks for having me.
Thank you.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 72345 and we'll set up a call so you can check us out and we can check you out. That's mentorwithrod.com or text CRUSH to 72345.